Okay, I'm Sue Konzelmann, and I am an academic here at Birkbeck and also on the PEF Council. So I just wanted to welcome you all to Birkbeck, and hopefully this will be the first in a number of different events like this that we'll be able to host. But I don't want to take up any of the valuable time because I know there are pressures, so if I can introduce Patrick Allen, who is the chairman and founder of PEF. He'll introduce this evening.
Thank you, Sue, and thank you very much, Sue, and Birkbeck for arranging this venue for us at very short notice. So we're delighted to be here, and this is a lovely theatre. So I am chairing today's event. I'm Patrick Allen, the chair of Progressive Economy Forum. The event is to launch an independent report into the concept of a financial transaction tax. The report's called Reinforcing Resilience, Making the UK a Citadel of Long-Term Finance. The report's written by Kevin Baradier, former head of derivatives product development at the London Stock Exchange, now working with NGOs. Also Laura Buffy, research and policy officer of Stamp Out Poverty. The report will be presented by Professor Avinash Persaud, chairman of Intelligence Capital. And the paper sets out the case for a comprehensive approach to financial transaction taxes. This event today is organised jointly by PEF and Stamp Out Poverty, a long-term advocate of FTT, and the director, David Hillman, is here on the platform and will speak. After Professor Persaud's presentation, we'll hear from Professor Stephany Griffith-Jones, then from the Shadow Chancellor, John McDonnell, and then David Hillman, and there'll be time for Q&A. I've been asked to say straight away that John McDonnell has to get away promptly. He has to make a speech in Scotland tomorrow morning, so he's got to catch a plane, and so he'll be off at 5:30. Train. Train. One way or another, he's going to get to Scotland. But you're welcome to stay for tea and coffee afterwards and carry on the chat. So I'm going to say a couple of things about PEF, and then off we go. So PEF was launched just over a year ago. We have a council of 20 UK economists and academics. We support and present innovative economic policy to bring the UK back to prosperity and kill off once and for all the doctrine of austerity and neoliberalism. Although we've only been going for a year, in that time our council members have published 78 blogs, delivered 5 public lectures, participated in workshops on the Bank of England and the National Investment Bank, published working papers, and nearly all council members have published a book, if not more than one. And more papers are in the pipeline. Now, the FTT is definitely fits the bill of an innovative policy. It's been around a long time as an idea. It was once called the Tobin tax, after James Tobin, who wanted to put 1% tax on foreign exchange transactions. And it would allegedly put sand into the wheels of financial transactions to slow down transactions and reduce unnecessary ones. We need stability in the system. 2008 showed how catastrophic it is for the financial system to fail. Liquidity was not there when we needed it. It took most people by surprise. It resulted in massive bailouts of banks from the public purse, and we must not let that happen again. The system is still unstable. As the report says, gross transactions have become a huge multiple of net transactions due to packaging and pooling, funding and trading of loans. And these multiple transactions do not increase productive activity. And this so-called fast finance has not been good for customers. It crowds out long-term investment. Fast finance costs consumers more, and it's making the system fragile. So the idea of FTT is to bring more stability and resilience to the system. The 2017 report by Professor Persaud suggested that extending the system would raise an additional 4.7 billion per annum in revenue. And this report today suggests a further 2.13 billion could be raised by extending the system to transactions for foreign exchange and commodities. These are massive sums and apparently quite straightforward to collect. So without more ado, I invite Avinash to present the report. He is the founder and chairman of Intelligence Capital. Before that, he was head of global research at State Street Corporation. He was global head of currency and commodity research at JP Morgan. He is a long-standing advocate of financial transaction tax.
Thank you very much, Patrick. Good afternoon, everyone. Good afternoon to this prestigious panel, and John and Stephany and David. Patrick said I was a long-standing supporter of the financial transaction tax, so I did feel a certain pang of guilt when he said that, because in fact I got to know David by being on the opposite side of this topic many, many years ago. And at the time I was a believer, like most people in finance, that finance was in cyberspace and there was no way you could actually control it. And there was no way that governments could control it. And then I became a director of State Street Bank, one of the world's largest banks in the world in terms of investing. And they asked me to sign a lot of stuff, sign away that I knew exactly what all the customers were doing, where the money was. And I began to realize that finance is not anonymous. Money is not anonymous. Anyone who's tried to open a bank account will know that money is no longer anonymous. Anti-money laundering rules and other rules mean that we know where money is. We know where money is trading, and we know where the beneficial ownership of things are. And we're getting better at that as well. And so over time, I began to realize that actually it was about a will rather than whether we could do it or not, whether it was feasible or not. And most people in finance appreciate that. They'd often say, well, it's feasible, but you should rather do something else instead. And that's when I began working more with David, because the more and more they came up with arguments for why you couldn't do it, I'd listen to that and I'd say, well, that's not quite right. And so I've ended up being where I am today and trying to explain why I think this is not only feasible, but also very good. Most people will talk to you about the amount of money it will raise, and I will talk a bit about that, and it will certainly help to finance potentially some of John's ideas and others. But I think that for me, it's actually about how it changes behavior in the financial sector. And I believe it will do more good in changing behavior than indeed all the money that we will raise. So there are two reasons really for doing this. But let me begin by saying a few words about Caval and Laurie, who are unfortunately very unfortunately unable to be here today. But I grew up in Britain since the age of 7. The insight and knowledge I'm going to talk to you about today was based on a career in investment banking in London primarily, but also in New York and Singapore and in Boston. But I was born in the Caribbean. And for hundreds of years, as you know, the Caribbean stood at the center of the most pernicious of international trades. And thankfully, humanity's lows are matched from time to time by its highs. And now the Caribbean is a place where the world's greatest civilizations actually come together and people live in peace. And there's a creative fusion of music and language and much more. As for a tiny region, if you think about where the amount of new music that has come out of that region, it's amazing, whether it's reggae and soca and calypso. But today the Caribbean has become thrust back into the center of humanity's destiny. It lies on the front line on the war on climate change. 2 years ago we had the previously once in a 1,000-year event of 2 Category 5 hurricanes in 2 weeks. And this year is turning out just as bad. I've just come back from the Caribbean after Dorian devastated the Bahamas. And it is climate change that's taken me out of the UK for the past 2 years. And thank God for that. You guys have been crazy in the last 2 years. I was invited by the Prime Minister of Dominica to help lead the recovery of Dominica from Maria. Dominica lost 226% of its GDP in 6 hours. When I began explaining that to people, many people didn't think you could lose more than 100% of GDP, far less than 6 hours. Large places are made up of small places, and so there's relevance here for here in the UK for what we're doing in the Caribbean. And one of the consequences of the Caribbean being on the front line is that they've become the most indebted region in the world, because mitigating and adapting for climate change is expensive. And the longer we take to do it, the more expensive it's getting. We'll be looking at how we fund higher seawalls, riverbank enforcement, slope stabilization, roof replacements, and that's just the beginning. So in the case of Barbados, we have shown that you can be fiscally responsible and they are fiscally responsible alternatives to austerity. So in the past, the Barbados are now involved in one of the largest debt restructurings that there's ever been as a percent of GDP. And it is, in the Barbados case, the most shared economic adjustment in history. We have the creditors and the borrowers sharing equally in that adjustment. We have tourists and the locals sharing equally in that adjustment. We have taxpayers and public sector workers sharing equally in that adjustment. And I think it's been a very good lesson to me that when economists, sometimes, I say that as an economist by training, like to hide behind mathematical formulas to veil the fact that everything is a choice. Austerity is a choice. And the moral legitimacy of the choices has hard economic and political impact. And in Barbados, the moral legitimacy of a program which all feel part has shifted outwards the frontier of economic possibilities. Even the IMF is backing our program with low interest loans. Now, any economist would be excited about the kind of policy entrepreneurism we're trying to do there. So when David approached me last year to conduct a further drilling down of my earlier work on financial transaction taxes, I was deeply conflicted. So thank God for Laurie and Kival, who've done most of the heavy lifting on this report, much of the latest research and investigation of some of the numbers. We had ideas, but we needed to back those up with numbers, a fair amount of calculation. A lot of people say when we talk about financial transaction taxes, but it'll impact behavior and that will limit how much you can raise. Well, the whole exercise of estimating how much you raise is about estimating how much turnover will be impacted. So that's the beginning of it. And they did a lot of that very hard work, and I'm very impressed with it. And I want to begin by sharing my deep appreciation for them. There are many dangers contained within Boris's Brexit. One is that we get too easily distracted by the buffoonery from the abiding lesson of that 2016 referendum, which is that the issues of legitimacy arise whenever policy appears detached from the lives of ordinary people. Whether we are part of the EU or not, we cannot pursue growth for the sake of growth. It is the adjectives of growth that we covet: sustainable growth, inclusive growth, transformative growth, growth that empowers all to live the life they wish to lead. And it is the dearth of sustainable, inclusive, and transformative growth that is, for the UK and the US, one of the fundamental failings of our age, with deep reverberations from Brexit to Trump. But this is not a mystery to be unraveled or paradox to blame. The reason why growth is so low, too slow to deliver an adequate level of public services, too reliant on the housing market to be sustainable, too imbalanced to bring a better life for all, is quite simply investment is too low. Investment is the fuel of sustainable growth. And the UK investment in factories and plant and machinery and research in skills has steadily declined since 1979 and is low across other countries and low across time. And the vehicle of investment is the financial sector. It is the financial sector that converts savings into investment, that marshals savings in a country and allocates investment. That is its purpose. Finance is not an end in itself, but a means to an end. It is a cost to investment that we need a sector that mediates between savers and investors. A successful financial sector is one which delivers effective, safe mediation at a low cost, at a low drag on investment. A good analogy is law. We wouldn't say that the larger the amount of money we spend on law is a sign of success. We need law to support the agreements that a productive and peaceful society needs. It's not an end in itself, it's a means. Success would be that we have effective contracts, enforceable effective contracts at a low cost. If we forget about international business for a moment, it does not make sense to gauge success on the basis of how much of GDP we're spending on local law or local finance, but almost the opposite. In the case of finance, success would be directly measured in terms of the amount of conversion of domestic savings, mobilization we call it in the jargon, the amount of conversion of savings into investment. How much? And at what cost? And at what degree of safety? And on those terms, ladies and gentlemen, empirically, unambiguously, our financial sector is coming up short. It is not fully fit for purpose. Our financial system needs to be modernized, refocused on delivering investment, improving access to all, and reducing costs. This is not some idle claim. This is what the overwhelming weight of the empirical evidence of our lived experience tells us. And I'm more than happy to take anyone on who questions it, because the test of any theory is its power of predictability. And those who champion fast finance may have regained their smugness of late, but they may need a gentle reminder that they failed catastrophically to predict the way finance would behave over the past 10 years. Fast finance proved not to be safer, not to be cheaper, and did not sustainably improve access to finance. And they like to say that no one predicted it, the crash. But that is a convenient urban myth. In the 10 years before the crisis, there were many who wrote about how banks were putting themselves at risk of catastrophe by the shift in banking regulation that they themselves had championed, the irony. Shifts that had magnified and sanctified fast finance. We need to bring more balance back to finance, and we need to do so through regulation. Regulation that includes fiscal incentives, as well as minimum capital requirements. Because capital requirements are not enough on their own. Because the business model of banks follows the regulatory model. The handmaiden of fast finance was not innocent new technology, but the regulatory model that the bankers crafted. I say this not as an outsider looking in, but as a former banker involved in much of those discussions. The main way in which we regulate finance is by requiring loans to be funded, not just by borrowing from depositors or the markets, but by capital. Now, capital is a word that many people talk about and some may not understand, but think of it as profits that are not paid out to staff and shareholders. Capital is there for unforeseen losses. But if the banks have to put up their own money that they could otherwise give themselves in salaries and bonuses and to shareholders, they can't distribute these profits in that way. That's a very expensive cost to them. And so they persuaded regulators that there were less risks to lending if the lending was done by the markets. The markets would spread risks across thousands of investors and therefore be safer. And so under the new banking regulation called Basel II, they could put up 1/4 of the amount of capital, sometimes less, than they would otherwise put up if the loans were held as traded securities. Behavior follows incentives. And this vastly incentivized the banks to switch into fast finance, to originate loans, but for them and others to earn fees, packaging these loans, securitizing them, selling them on, managing them, and trading them. The risk that I'm known for identifying before the crash is that spreading risks is only effective if the spreading leads to a greater diversity of behavior. But because the game is no longer about holding risks but trading them, and so holders felt that they didn't need to really understand the risks because they won't be holding them for very long, they began using standardized models for valuation, for risk management, for trading. And so when one of those standardized models said they should sell, everybody was selling. Regulators thought standardization was good. But when these models created that homogeneous selling action, we lost liquidity. Moreover, because in the new form of fast finance, everyone is trying to minimize capital, no one had any spare capital to absorb losses in the marketplace. When trades that are coming, so no one had the ability to hang on to trades that are losing money in the hope they may come back later on. And so what this meant was the game of finance moved from holding on risks and therefore understanding risks and analyzing risks, but how to make sure you're the first one to leave the room when the going gets rough. How to invest in technology and practices that meant you were first out of the door. So more capital is one necessary solution, but it's not enough. It would still favor trading over holding of risks. A fractionalized financial system makes more money from those who trade more, and so their business is courted through more access to liquidity, to opportunity, to ideas. This is a classic social externality, where the private profits earned from churning means that there will be more churning than is socially optimum. The social optimum is partly about the instability of the financial system, trying to minimize the instability of the financial system, where everyone has become a trader and no one is an investor, where there are no safe hands. Because the risk management of a trader is to get out before everyone else does. I'm not against trading. We need trading. I'm in favor of balance. We need traders to help us discover the current price of things. Price discovery, we call it. But if the entire market is about trading and not about investing, no one is considering and investing about the future value of things. Economically, the most efficient way of addressing this is to have a tax on churning. And there's another reason too, one which I did not foresee. I assumed that the fractionalized financial system we were seeing was cheaper for consumers. Everyone in the market said so. The price of each transaction was tiny. The problem is that for each underlying risk, there were now multiple transactions. And when all of the fees from these transactions were added up, the cost to the non-financial sector of raising money was even larger. It had not fallen. And this empirical work was done for the first time by Thomas Philippon. He found that the cost of the non-financial sector, raising money from the financial sector, was around 1.7% of the capital raised. And this number was actually higher today than it was in the bad old days of highly regulated finance in the 1960s. And it was no lower than it was in the 1880s. The gains from all of the technological advances since the steam age have not gone to consumers, have not reduced the cost of finance. Fractionalized finance is not cheaper. Churning and multiple fees have been used as a way of deceiving consumers into thinking that it is cheaper. If taxes on churning, as we expect, reduces churning, then consumers will actually end up saving money from this tax. If your pension fund and fund manager is not churning as much as they did before, and now this churning becomes taxed and visible, then consumers will save more. Financial participants get benefits from churning finance, but consumers do not. There are, for instance, here's an interesting statistic. There are no fund managers in the UK that have delivered returns that have beaten the market index, for more than 5 years in a row. None. We have thousands of fund managers. In the United States, there are over 5,000 fund managers, and none have beaten the market index for 5 years in a row, in part because of the costs of churning and the costs of their management. Investment is down and has pulled growth down with it. Fractionalized finance has divided up fees into a large number of small fees for a given amount of finance. But when all these fees are added up, the cost of finance to the non-financial sector has not fallen. In our own small way as consumers, we have also experienced that, the higher costs of banking. You might remember the dim and distant past, there was actually a bank branch in your high street, when you would go in, queue up, and get your cash out with no cost. Now you go to an ATM machine and you quickly say, yes, I accept that 1.5% fee, that £3 fee. In fact, fees that are far in excess of the financial transaction tax you are paying daily as you take cash out from your own bank, your cash from your bank. And of course, there are more than that as charges, whether it's charges for your checks, charges for your overdraft, charges for your loans and mortgages. Market finance has little capacity for absorbing losses today. Liquidity looks plentiful in the good times, but it's fake liquidity, and markets are more fragile than ever before. A tax on churning and more capital will help to incentivize a different kind of finance, one more fit for the purpose of investing and give access to inexpensive finance to all. The financial sector reminds me of that old-fashioned story of the Brit going abroad, finding that he's speaking to someone who doesn't understand English, and resorting to speaking louder and slower. No apparent amount of repeating that FTTs don't work can erase the fact that stamp taxes are some of the oldest taxes in history, have been around for over 300 years, are employed by over 40 countries, and that they are some of the cheapest taxes to collect of all the taxes we have, according to the Institute of Financial Studies. And today, they're done through electronic stamps, digital stamps at the clearinghouses. And they have one of the lowest rates of avoidance, because your contract is not legally enforceable unless it's taxed. And that is why the FTT in the United Kingdom, our stamp duty on share transactions, is paid by more foreigners than almost any other tax we have. A tax that is supposed to be so easy to avoid, paid by foreigners who are not even UK tax residents, because they do not wish to have contracts that are not legally enforceable in the United Kingdom. The essential thing to remember is that this is not a tax on venues. People say if you put this tax on, people will move from the London Stock Exchange or move from trading in London. This is not a tax on where you trade. It's not a tax on the where. It's a tax on the who. If you have a 3-month job abroad and you get paid an income, you don't think, oh, because it was abroad, I don't need to pay tax on it. You need to declare that income in your UK tax. Why? Because you are a UK tax resident. So it currently happens today when you own shares. If you own foreign shares today, you bought shares in New York, you get paid a dividend from those shares. You have capital gains from those shares, you pay UK tax on that. There's nothing weird and wonderful about that. An American trading foreign shares in the UK will not pay the transaction tax. And so their trading has no reason to move. And the reason why they won't pay the transaction tax is because it's not a tax on the where. They are not UK tax residents, and they're not buying something that is taxable in the UK. So why would they move their trades? A British resident who's buying a UK instrument, a UK tax instrument, a UK financial instrument, will pay tax whether they trade in the UK or Hong Kong or Singapore or New York. So why would they change their venue from where they are today? This is not about eliminating trading, but about right-sizing its role, about offsetting the private biases in favor of excessive trading. It's why a tax that addresses that directly, disincentivizes excessive trading, is the right route. What is being proposed here is about leveling the playing field, taking the existing tax on share transactions that has been hugely successful for over 300 years, allowed the UK stock market to be the 4th largest in the world, has successfully raised over £3 billion per year, and spreading it across other asset classes on the principle of UK tax residency. This will more than double the tax take than we have today. Considerable new funds, an extra £2 billion per year as a conservative estimate in taking this tax beyond share transactions to other types of financial instruments and leveling the playing field, not discriminating against different types of instruments. But as you've heard me say, I think the benefits of the financial transaction tax is far greater than that. Because if we do this, and we bring a greater balance to our markets, and long-term investors are now on a level playing field in their access to liquidity, to opportunities, to ideas, our markets will be less prone to the earthquakes we've seen and the tremors of flash crashes. Our markets will be where finance is cheaper because there's less churning. And this will attract long-term investors from all other markets around the world. We will build a new and more inclusive marketplace here in the UK. We will build a new Citadel for long-term investing. And this, ladies and gentlemen, is the best defense, the best hedge, the best solution or second best to the prospect of Brexit. Because the current model of fast finance and fractionalized finance is highly dependent and vulnerable on our current relationship with Europe. Finance today is a means to an end. Today, in the shadow of the largest financial crash in living memory, that cost $20 trillion globally, required our banking system to be bailed out by taxpayers and meant the defunding of many important social programs. Today, in that shadow, I safely, confidently, empirically say that finance is not fit for purpose. And there is growing evidence of the costs and risks of excessive financialization from fast finance. But if you want to change the financial model, we have to change the incentives. Leveling the playing field and extending the FTT to other markets does that. Thank you very much indeed.